You will recall our earlier discussion a few sessions ago on capital adequacy ratio under the Basel I guidelines implemented worldwide in the mid-90s. In the Basel I guidelines, as you will recall, capital adequacy ratio was defined as the ratio of the bank's capital comprising Tier 1 and Tier 2 capital to the risk-weighted assets, where Tier 1 capital comprised equity capital and other forms of perpetual capital, and Tier 2 capital comprised long-term debt, specific categories of reserves, and provisions for loan losses. Risk-weighted assets involved assigning risk weights to the various categories of assets on a scale of 0 to 100. For example, investment in government securities and T-bonds, which are considered risk-free, was assigned a risk weight of 0%, whereas unsecured loans were assigned a risk weight of 100%, and say home mortgages loans a risk weight of 50%, since those loans are backed by the home as a collateral. Now let's look at the changes implemented under Basel II. Basel II rests on three pillars: the minimum capital requirements, that is Pillar 1, Pillar 2, supervisory review process, and Pillar 3, market discipline. Now let's look at Pillar 1, minimum capital requirements. Pillar 1 of Basel guidelines aligns the minimum capital requirement more closely to the bank's actual underlying risk by providing a menu of approaches to choose from for computing capital adequacy. Moreover, for the first time, capital charge on operational risk has been mandated under Pillar 1, which we will discuss in great detail a little later. Pillar 2, supervisory review process. Pillar 2 mandates that the board of directors and the management team of every bank will have primary responsibility to ensure that the bank has adequate capital commensurate with its risk profile. Under Pillar 2 of Basel II, the banking supervisors will be charged with the responsibility to evaluate whether or not the banks are assigning their capital requirements properly in relation to their risks, and if necessary, the supervisors may intervene to mandate a higher capital requirement for specific banks. Pillar 2 is expected to also capture those risks not captured by Pillar 1, such as liquidity risk, reputation risk, and so on and so forth. The business cycle effects, which represent factors external to the bank, are also to be captured under Pillar 2. And now for Pillar 3, market discipline. Regulation is not and cannot be an alternative to market discipline. In fact, market discipline supplements regulation in the sense that monitoring of the banks and financial institutions is not merely carried out by the regulators, but equally so by the financial markets and stakeholders in every bank, including the equity stakeholders, the depositor holders, holders of subordinated debt instruments, rating agencies, other financial institutions, and so on. Market discipline enforced by those set of stakeholders through a higher level of disclosure, both in the annual statement of accounts and otherwise, can be as powerful as, perhaps more effective than, the guidelines and directives imposed by the regulator. So that was an overview of Basel II guidelines. In the next session, we will look at Pillar 1 minimum capital requirements in much greater detail.